Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hope everybody had a very good day. And in today's markets, guys, the extreme volatility of this week simply continues. We were saying before the week started, it may just be one of the most volatile weeks of the entire summer, and maybe even one of the most volatile weeks of the entire year. And so far, it definitely has not disappointed. We've really pivoted between fear and euphoria a number of times just over the last 3 days. On the Tuesday session, the QQQs were down about 2%, guys, culminating in massive fears surrounding big tech earnings and semiconductor sell-offs as well. A lot of those fears were abated yesterday when we had a very good day, renewing confidence in the bulls' ability to recapture some of the losses when we had good earnings from Microsoft, great earnings from AMD, and a fairly bullish Jerome Powell. And then we had today, right? So Tuesday, 2% down, Wednesday, almost 3% to the upside, and today, erasing almost all of yesterday's gains, another almost 3% day down on the QQQs. However, guys, the day wasn't always that bad. We started off the morning relatively fine, as a matter of fact, continuing off the bullishness of Meta earnings from the yesterday session. And then around 10 o'clock in the morning, guys, right around here, everything started unraveling. So what exactly happened at 10 a.m.? Well, unfortunately, we got an ISM manufacturing report that came in very, very weak, which hinted at signs of an economic contraction, the likes of which we hadn't really seen in the GDP report as of 2 weeks ago. So guys, in today's video, we definitely have a lot to talk about. Number one, we're going to be going over that ISM service manufacturing report and see what exactly caused the markets to have such concerns over a potential recession narrative, which was the topic of the day. Number two, we're going to go through a few earnings that I have prepared for you guys, and those are going to be Amazon and Apple. Now, I know we have a lot of other companies that reported today that could be interesting to look at, but in hopes of saving time for the video, guys, we're probably going to go through a few of them in tomorrow's session. So for today, only Amazon and Apple, your two biggest releases of the after-hour session. Now, number three, we're going to do a full technical analysis rundown on our major stock market indexes right here, and then dive into our big tech names and see who is exactly in control right now. We have a lot of back and forth between the indexes, between big tech names over the course of the week, and we really need to understand whether or not it represents a good buying opportunity or whether or not we may be able to see significant further downside if this recession narrative continues playing out in the markets, right? So a lot to cover today, guys. Let's jump right into the action. So SPY down, unfortunately, 1.42%. QQQ down 2.42%. At one point, they were down over 3% before retracing a little bit into the close. Overall, though, guys, a lot of your major indexes were down, only healthcare showing a little bit of signs of life for some healthy rotation. Take a look at your heat map right here, and you will see the heat map is not the best. Other than healthcare and Meta continuing bullish after its earnings, it really was a big tech destruction day once again. And unfortunately, in the after hours, guys, Amazon dropping about 7% after their earnings, Apple ending roughly flat, so we're not going to get much help in terms of their financials not performing very good. We did have some, as I said, good performance in healthcare, but as a whole, guys, very, very, very bearish market performance today. Only real estate and utilities were up today because interest rates were potentially coming down in the month of September, right? Bonds have been rallying ever since yesterday's FOMC meeting with Jerome Powell, just because of the expectations of rates coming down. It really helps those interest rate sensitive sectors such as real estate and utilities. Moving on to the one-day performance, guys, you will see that even better. Utilities, real estate, consumer defensives, and healthcare, your pretty much anti-recessionary segments and the segments that respond well to decreases in interest rates, those were the only ones that were green. Everything else really in the red, which brings us to a 1 week relative performance where still we do have some gains in the market. We haven't given everything back, but energy and technology, your major loss leaders to the downside once again. Take a look, guys. Number of names that were up versus down. Not a very good day for the SPY. 174 names up and 328 down. So it just goes to show you there was a lot of selling pressure across the board in today's markets. Now, let's get in right away to that ISM manufacturing report, and we're going to go over a few key points together as to why it was such a devastating impact on the markets today. Now, here you go. So the expectation for ISM manufacturing PMI was set at about 48.8, and we came in 2 points under, guys. Anything below 50 shows that the economy is contracting. Now, that is a stark contrast to what we saw in the GDP numbers just roughly 2 weeks ago, which brings us to the conclusion that the markets are asking the question right now: was Jerome Powell too late in potentially starting to cut interest rates? Is there too much damage already done? And are we now maybe starting to see some of that damage, which could manifest itself into future reports in the month of August and in the month of September as well, prior to the rate cuts? That is a very, very key point of focus right here. If the economic data gets worse and worse leading into the September rate cut, it will no longer be an accommodative rate cut. We've talked about this on the channel, right? There's two kinds of rate cuts. One is an accommodative style where the economy is doing good, the jobs market is doing good, inflation is going down, and the Fed just starts decreasing interest rates to lift a little bit of pressure off the economy to prevent it from crashing, right? The other style of rate cut is a responsive rate cut, and whereby things get significantly worse in the economy and the Fed is forced to cut interest rates to stimulate the economy to prevent it going into a large form recession, right? So now we're kind of pivoting from the accommodative rate cut, and then when we get data like this, guys, it starts to really fuel the narrative that the Fed may have to do a reactionary rate cut, which is the worst case scenario for the markets. So let's get into that ISM services report, guys, and you will see that it's not very good. So where do we sit? 46.8%, guys. You will see if I blow up this chart right here, right? So you will see that we are now coming down into the lows of 2023. Now, this is not a very good thing at all, guys. We're supposed to be recovering ever so slowly. And in the first half of 2024, we were, but we've been significantly declining. We've heard that from the consumers, of course, pulling back on spending. But now the other side, the supply side of the economy, is saying that we may just have a little bit of a problem here. So let's have a look at exactly some of the numbers and what was said. So U.S. manufacturing activity entered deeper into contraction. Demand was weak again and output declined. Demand remains subdued as companies show an unwillingness to invest in capital and inventory due to the current federal monetary policy and other conditions, right? Hinting at the fact that they are tired of high interest rates and they will not invest while interest rates are this high. Production execution was down compared to June, likely adding to revenue declines, putting additional pressure on profitability for manufacturing businesses. Let's take a look at what some businesses in some segments of the market had to say, and we will see, guys, it's not very good. These are leaders of their industry in manufacturing. Business is relatively flat, the same volume but smaller orders from chemical products. Demand continued to soften into the second half of the year. Transportation equipment. Now, here's from food, beverage, and tobacco products. Listen to this one. Even though we are used to a seasonal reduction in business over the summer, consumer behavior is changing more than normal. Sales are lighter and customer orders are coming in under forecasts. It seems consumers are starting to pull back on spending. That we've heard before, of course. Now, moving on, it seems that the economy is slowing down significantly. We are hoping for an increase in customer demand, or we will possibly need to make organizational changes. Machinery. Unfortunately, our business is experiencing the sharpest decline in order levels in a year. We were well below our budget target in June. As a result, it was the first month this year that we have negative net income. Fabricated metal products. Business is slowing and we are taking cost actions. This is electrical equipment, appliances, and components. Guys, it's everybody. Some markets that are usually unwavering are showing weakness. This is non-metallic mineral products. And lastly, elevated financing costs have dampened demand for residential investment. This has reduced our need for component products and inventory. Wood products, talking about housing demand, right? So housing demand possibly starting to be on the decline. Take a look at all of these segments, guys, of this chart, right? Look, everything pretty much declining right here. Directions are all contracting from the PMI, new orders, production, employment. Everything is contracting and the rate of change is faster. Inventories as well, right? Customers' inventory too low. Prices, however, are increasing, oddly enough, 6.8%. Normalized to annual basis, guys, that is pretty much a 4.8%, 5% in manufacturing prices. Definitely not the best. Once again, guys, this comes into your goods inflation, which has been on a necessary downtrend. But now this, in my opinion, is somewhat of an anomaly. It's very, very strange that while we have contracting demand, pricing is still going up. So we'll see if this is a trend, but this is definitely an anomaly. It was not in the last report. Backlog of orders contracting, new export orders contracting, and imports as well. And here is the final report card. Overall economy is growing, but slower. We hinted at this when looking at GDP numbers 2 weeks ago. The manufacturing sector contracting at a faster pace. So these are the fears that sparked off the massive sell-off, guys, that we had early at 10 o'clock this morning as soon as that report came out. And pretty much after that, it was algorithms just smashing the bid the entire time. So we have now pivoted, guys. I want to do this before we get into earnings, right? We have now pivoted. Very important to notice the pivot in what is Wall Street paying attention to now. The market is shifting the focus of their data points. For the last year and a half, inflation was the biggest concern, right? The markets would move very heavily off of CPI news. But now, in the past 2 months, you guys have noticed the market doesn't really move off of inflation data anymore because inflation is pretty much dead. Now, the focus is on the jobs market and the economy, putting pressure on Jerome Powell to cut rates. Has he waited too long? That is the question that the market is asking itself after that manufacturing report. Now, what's funny in the matter is prior to today, everybody had agreed on September rate cuts. Literally everybody was saying September rate cuts are coming, and the markets were fine with that. But now, after today's data point, now that it's almost confirmed with yesterday's Jerome Powell meeting, right? The markets are starting to say it's too late. So it's very, very funny how markets are emotionally reacting to today's data set. It is only one data point. They are now completely ignoring the positive GDP report that we got 2 weeks ago. They're ignoring the positive inflation reports that we got, and they're focusing on this one sole report and the timing of these interest rate cuts. In other words, guys, the markets are getting impatient with rate cuts. They do not want to see the economy deteriorate and decline waiting for those rate cuts. So that is why there's a little bit of panic in the markets today. So it is of utmost importance before the rate cuts over the next month and a half that we pay especially close attention to any jobs report and any data points coming out of the economy. They will be the largest driver of market price action, in my humble opinion. And the focus of that, guys, is going to be reiterated tomorrow when we get the non-farm payrolls jobs report in terms of how many jobs were created. Be very careful with this one, guys. If this one comes in significantly below the estimate, I do not believe that will be a good thing. It used to be a case in point where when these jobs reports would be coming in a bit weaker than expected, the markets would respond positively with gains. Why? Because that signaled that the economy was weakening, the jobs market was weakening as well, and Jerome Powell would have to cut rates sooner than expected. Well, now that Jerome Powell has pretty much said indirectly that September rate cuts were on the table, they're getting a little bit more impatient with it. So very, very funny to watch the market's price action in times like this. So just pay special attention, guys, to any and all jobs reports and economic data that come in before that September rate cut date, which is going to be about the midpoint of September. So that being out of the way, guys, let's jump right into our two major earnings that we have prepared for the day. And then we're going to go through a lot more in depth through all this macro data and price action. We go through the technical analysis of the indexes, right? So moving on into it, guys, let's cover the first one on deck today. And that is going to be Amazon. So Amazon actually had a very nice earnings report, guys. But similar to the rest of big tech, right? You saw it with Netflix, you saw it with Google, you saw it with Microsoft. If the report is not pristine perfect, and if guidance is not pristine perfect as well, there is a lot of nervousness towards big tech right now. And that is exactly what happened with Amazon in today's report. Amazon, unfortunately, in the after hours, you can see it right here, declining almost 7.5% despite having a very, very decent quarter. Take a look at the numbers right now, right? EPS beat by a massive 22%. EPS is a measure of profitability. And I've been saying this entire year that Amazon is going to have one of their most profitable years on record. So far, that is coming true. However, they did miss a tiny little bit on revenue. A very rare miss on revenue by Amazon nonetheless. So let's have a look at exactly what happened in the data to warrant a 7.5% decline. Amazon shares slide on revenue miss, disappointing guidance for the third quarter. Take a look, guys. The guidance, similar to a lot of other tech names that are reported so far, the guidance wasn't actually all that bad. They missed ever so slightly, but you guys have seen what's happened in the past 2 weeks. Anything under perfect is getting extremely punished. And when it's good, even then, stocks really don't respond that much higher. So very, very nervous market environment right now. Let's take a look, shall we? So Amazon Web Services, the place that people pay the most attention to, that was a nice beat, 26.3 versus the 26 billion expected. Advertising, also one of the major points of contention for the business, 12.8 billion versus the 13 billion expected. So they beat on AWS, but they missed ever so slightly on their advertising revenue. Let's take a look. Amazon forecast revenue in the current quarter, so this is the guidance, very important, to be between 154 billion and 158.5, representing growth of 8 to 11% year over year. The midpoint of that range, 156 and a quarter, trailed the average analyst estimate of 158.25. There is your guidance miss, guys. A 1% miss in guidance led to a 7% decline in share price. We've seen this with Microsoft just the other day. We've seen this with Google just the other week and Netflix as well. So it's no surprise that Amazon is being punished. Amazon continues to reckon with sluggish growth in its core retail business. This is very interesting, guys. This is consumer discretionary spending data at its finest. Amazon has some of the best data on consumer spending because of the sheer amount of people that it serves. So let's take a very close listen at this. As retail competition heats up, largely from discount sites like Temu and Shein, which allow Chinese merchants to sell cheap items into US customers. Sales in its online store segment grew just 5% year over year. We did come in a little short on revenue growth in North America versus our initial estimates, said the CFO. Now, the CFO continued in saying the revenue miss was driven by consumers choosing to buy cheaper products, leading to lower average selling price. Same thing that Walmart and other retailers have been saying as well. He continues, what we're seeing is really around average selling price and lower ASP in products selected by customers. They are continuing to be cautious in their spending and trading down to lower cost products. Amazon expects third quarter operating income to be in the range of 11.5 to 15 billion, compared with the 11.2 billion in the year ago period. So operating income is going to be very good. However, analysts surveyed forecast 15.3 billion in operating income, right? So they gave a range of 11.5 to 15, and unfortunately the analysts were well above the target. So this again is an operating income guidance miss, unfortunately, for Amazon. In cloud, however, AWS beat estimates, growing 19% from a year earlier, but the unit is expanding at a slower rate than Microsoft and Google. They both put in about 29% respectively in their cloud divisions, right? However, I will remind you that Amazon remains your industry leader, so their focus has to be perfect at every single point, right? They need to be maintaining their lead right now. AWS currently has 31% of the market share, followed closely by Microsoft Azure, and then Google Cloud coming in at 11%. So Microsoft growing at 29% this quarter, and AWS only growing at its rate of 19%. It shows you that Microsoft is catching up ever so slowly, right? That is going to be the focus of AWS in the next few quarters. Advertising. Amazon's advertising revenue jumped 20% during the quarter, just falling shy of estimates as we saw, but still 20% is a very good number, guys. Net income at Amazon doubled from a year ago to 13.5 billion, reflecting mass cost-cutting efforts across the company. And this is what I want to focus on, guys, right? Yes, we've had a few negative points from Amazon. Number one, the guidance miss. Number two, the fact that they're saying consumers are weak and trading down to lower cost products. And number three, the fact that their cloud revenues are growing less quickly than Microsoft and Google. However, guys, we need to focus on what Amazon is trying to do here. They're trying to improve profitability, which will improve the fundamentals of the business, and that they are really nailing down. Let's take a look at their profitability, guys. So net sales trend, very, very nice to the upside. This is just a few slides we're going to go through, right? Operating income is significantly higher, 91% year over year. This is your profit metric, one of the key focuses of Amazon over the course of this year. Now, let's take a look at this. Segment results: North America, sales up 9%, operating income up 58%. Very good numbers from Amazon. International was up 7% year over year as well. Operating income still coming in at a little bit of a loss, but that's no stranger to Amazon, guys. They're still trying to expand their international business for the most part. Now, moving on in, this is the slide that really takes the cake for me. Free cash flow on a trailing 12-month basis, it is up 572% year over year. Fantastic, fantastic, fantastic free cash flow growth. Absolutely insane to see Amazon putting in these numbers. If you guys want to see in terms of their free cash flow expansion, guys, take a look at this, right? Free cash flow expansion by Amazon. Look, they were generating almost no free cash flow prior to 2018, and then they really started ramping up efforts. Then in 2021 and 2022, they put out massive capital expenditures, scaling up their retail business, building a ton of factories, warehouses, and also investing heavily in robotics too. And that is now starting to pay dividends. Look at their free cash flow now. And as you can see, guys, their trailing 12 months right now is 53 billion. On this chart, that would put them all the way higher than this most recent number. You can see crazy, crazy free cash flow expansion by Amazon. And also in terms of their net profit margins, guys, right? Their net profit margins are very good. I'm not sure if I did them right here. I think I did not label them on the chart, but all you need to know is their net income for the quarter was pretty much 9.1%. 9.1% net income for Amazon, guys, is one of the best numbers that they've had over the last 2 years, even more, right? You can see on a yearly basis, they generate anywhere between 4, 5, and in their best year, most recently, 7% in net income. Last year was about 5.29. Now this quarter has beat every single one of the past 5 quarters. Net income of 9.1%, right? So take a look at the profitability for Amazon. You can see they've been improving gross margins these past few years. Operating margins, after taking a little bit of a dip in 2022, are now back to record high levels, guys. This is 15 years worth of data. Operating margins are now going to sit very pretty, and today they were about 10.5%. Very, very strong, extremely strong, if I have to say so myself. And net margins, guys, as you can see, their best quarter ever was at the end of 2021. They just put in even better, 9.1%. And I do believe that this chart will continue growing to the upside as Amazon continues to focus on profitability, guys. So that, in my opinion, is the highlight of this entire quarter. Amazon's shift from growing top-line revenue to now expanding on bottom-line margins, which gives us better fundamentals for the business as a whole, right? If they're expanding bottom-line margins, it means they can expand EPS quicker, which means that their valuation is going to shrink at the current share price, right? If they can continue expanding margins like they've done, in other words, this PEG ratio is going to get better and better and better as we move into further profitability for Amazon. So that's pretty much the gist of the report right there. So very mixed report by Amazon, but I personally did find this report to be very, very good. Is the retail segment slowing down ever so slightly because of consumer discretionary weakness? Yes, but they're improving profitability, and that is something that we cannot ignore. That is a long-term focus for Amazon. So this cyclical consumer downturn is just that. It is cyclical. It will eventually get better. The focus on profitability, however, that will be for the long term, which is why it's still one of my favorite investments right now in the entire market. A lot of people do not see this coming. Amazon's improvements in profitability, the amount of free cash flow that they're going to generate, guys. By next year, Amazon will finally be able to start doing very, very big buybacks, in my humble opinion. And by 2025, I really think this one is going to absolutely fly. Take a look, guys, at their EPS expansion curve. You can see that for the foreseeable future, because they're focusing on profitability, look, EPS was roughly flat over the last 4 years. Look what they're trying to do here, guys. Massive EPS expansion, even though they are growing revenue very healthily. So the focus on profitability is going to be number one for Amazon, in my humble opinion. So let's focus on their numbers right now, shall we? So in terms of Amazon's valuation, are they a good deal or not? Well, they're growing revenue and EPS at very healthy double-digit numbers, especially this EPS, which gives them a forward PE at $170, where they are in the after hours right now, of 36.9. First glance appears a little bit high, but when we divide this by their EPS growth rate, we get a PEG ratio of 1.42. 1.42 for Amazon, guys, is very, very cheap. Anything under 1 is a great deal. Between 1 and 2 is okay. And over 2 is expensive. For Amazon to be sitting at a 1.42 while expanding profitability and expanding EPS is a very decent deal in my humble opinion, guys. And even on the technicals, I really like this one on the technicals, guys. Sitting at 170 right now, that will put us pretty much, let's just call it 15% off the all-time highs. And Amazon has had a little hiccup like this in the last quarter. You saw they dropped roughly the same amount, right, after their earnings last time, about 7.5%, and they were able to recover that. Now, the markets were also in a little bit of a dip period in the month of April. So once the markets get out of their dip, I do believe Amazon will have a very easy time at recapturing these losses. But what I wanted to tell you guys is every time Amazon is roughly 15% off of their all-time highs, 15% or more in the context of an overall bull market, usually it's been a great opportunity to buy some stock, right? So I will say that myself as well, that it is a good opportunity to be buying Amazon stock right now, whether it be for a longer form swing trade or maybe even a long-term investment, talking about the next 2 to 10 years. Such a solid company and one of my favorite in the game so far. So that's pretty much everything for Amazon. Now let's dive into another big one, guys, which is going to be Apple. Now, Apple coming in after the bell, and they reported earnings, and you can see it was a very, very volatile after-hour session for Apple, and they did, as a matter of fact, end up green after their after hours, right? By only a fraction of a percent. So what exactly did Apple report? Now, Apple reported a double beat. Apple is very, very tough to find them missing on EPS and missing on revenues, so no surprise there. But the focus on Apple is going to be the continuation of revenue growth. That has been one of the criticisms of Apple over the last 5 to 6 quarters, that the revenue growth is really flattened out, right? And we can see that pretty much when we dive into their quarterly revenue. As you can see right here, their quarterly revenue, guys, over the last 6 quarters has really been flat. And this quarter as well, arguably, is somewhat flat in relation to the last 6 quarters as well. Now, can they get better, guys? Because it's been relatively flat over the past couple of years. That is what we need to focus on. So even though they have a double beat on EPS, beat on revenue here, let's take a look at what they're saying in terms of the revenue expansion, right? So let's move into it right away. Now, moving into Apple. So Apple says Apple sales rise 5%, topping the estimates as iPad and services revenue jump. So let's take a look at some of their business segments, shall we? So iPhone revenue, decent little beat here. A lot of criticisms around Apple's ability to continue generating higher and higher iPhone revenue. Do not forget, guys, iPhone revenue is literally 47% of all of Apple's businesses. So we need to continue to see that going up. Nice to see that it was up versus the expectation. Mac revenue as well did come in roughly in line with the expectation. Slight miss there, but no red flag in my humble opinion. iPad revenue was a very nice surprise, 7.16 billion versus the 6.61 expected. Very nice highlight there. Apple released a new generation of iPad over this last quarter and has been performing very well for them. Now, wearables, home and accessories was also a beat, 8.10 versus 7.79. And their services revenue, which was one of the highlights for Apple, right? Why is services so important? Because they have the best margins, guys, right? So take a look at this as Apple's statement of operations right here. You can see that the services do bring in a fair amount of revenue, arguably roughly around 30%, right? However, the net margins on this line of business are far greater than its product line, right? Product line, they have decent net margins, nothing fantastic, around 25%, which is very good for a product business, right? However, services is really where this company shines. Services, right? You can see that they have a 74% net margin, 24 billion in revenue, and only 6.3 billion in cost of goods sold. So operating margins are 74%, which is why people focus on this aspect so much for Apple, because that is where a lot of their profit margins come from, right? So you need to see this segment growing, and growing it has been. So gross margin coming in better than expected as well. So for the most part, guys, all of Apple's lines of businesses have performed quite well this most recent quarter. Now, Apple expects about similar overall revenue growth in the current quarter as in the June quarter, which was 5%. Still a little bit light in my humble opinion. Apple also expects services to grow at about the same rate as the previous 3 quarters, which was about 14%. This is really the highlight of the business, guys. They need to continue growing services in the mid-teens to really have a chance at continuing this overall revenue increases as well, right? Now, Apple's most important business line remains the iPhone, which accounted for about 46% of the overall sales during the quarter. While Apple beat the estimates, the product line still declined about 1% on an annual basis to $39.29 billion in revenue. So their iPhone product line, guys, is somewhat stagnant right now. A lot of people are going to be waiting for the AI phones, which are said to be released in the month of September. So it could be a massive upgrade cycle for Apple coming in Q3 and Q4. But as of right now, the first 2 quarters have been relatively flat for iPhone sales. Now, here's what Tim Cook had to say, the CEO. What we've done is we've redeployed a lot of people on AI that were working on other things. From a data center point of view, as you know, we have a hybrid approach. So we both have our own data centers and we partner with people. And so that CapEx, because a lot of focus obviously has been on the amount of money that big tech is spending on data centers, right, to increase their AI capacity. It's been a focus point for Google, focus point for Microsoft, Amazon as well, and now even Apple. So Tim Cook obviously had to address this, right? So he said they run a hybrid model, some that they have themselves and some they pay people for. And so that CapEx would be in the partners' financials and we would be paying expenses. Now, certainly embedded in our results this quarter is an increase year over year in the amount we're spending for AI and Apple Intelligence, Cook continued. But they have to do it, guys, right? The risk of being behind the AI curve is far greater than the risk of over-investing in AI, right? And a lot of CEOs have said that. The CEO of Google said that. CEO of Microsoft said that just the other day as well. Now, moving on, Apple showed strongest growth in its iPad division, which grew nearly 24% year over year. Tim Cook said that about half of iPad buyers haven't owned one before, suggesting the tablet market is not yet saturated. Now, here is Apple's quarterly net sales, and you can see why people are criticizing Apple so much. So yes, their quarterly sales are now up on a year-over-year comparison, but a far cry from what they were back in the height of consumer spending, which was pretty much 2021 into 2022 after the pandemic. So Apple really needs to find a way to get back to growth, guys. And that's why they're betting so heavily on AI, on that upgrade cycle, right? They're really counting on the AI applications that they're going to be integrated into their wearables division, into their Mac division, and also into their iPhone division, right? So hopefully for them, it bears fruit and we are able to see a net revenue increase over the next 3, 4, 5 quarters leading into 2025, which analysts say is going to be a much better year of growth for Apple. Remains to be seen, however, right? So Apple definitely is right now on the chopping block, suffice to say. Apple said in a statement that it had more active devices in each of its regions than it ever had before, without providing a specific number. So nice to see that at least their active users and active devices are at a net increase, although they didn't give a number. Apple said it had 1 billion paid subscriptions, which includes subscriptions to iPhone apps through Apple's App Store. Very, very good for Apple, right? This just goes to show how strong their services division is that encompasses those App Store purchases. However, Apple sales declined 6% in Greater China, a region that also includes Taiwan and Hong Kong. Apple is under pressure in mainland China as local rivals such as Huawei introduce competing products. Here's what Tim Cook had to say. I don't know how every chapter of the book reads, but we're very confident in the long term, Cook said on a call with analysts, right? So we've noted that from Tim Cook. Tim Cook remains bullish on the longevity of the company. That's for sure. You can't really expect him to say the contrary, right? But one thing that I've noticed about Apple over the last 2 quarters is although they're very, very hype about their new AI products, they don't want to comment too much on active users and potentially losing market share in the Chinese market. 2 very real things that are happening right now. So we need to watch out for that on Apple. I will remind you guys, right, what we were looking at before in terms of the temporary issues for Apple. Now, we did have a couple lawsuits, yes, but these still remain, guys. They still haven't really fixed this, right? 5, 6 quarters of flat revenue growth, China slowdown and competition, Vision Pro too expensive, lack of phone innovation. We'll see with the new AI phones coming out. Warren Buffett selling, and AI is underwhelming. But we need to focus on the long-term pros, 3% buybacks per year, best ecosystem in the world, huge moat in the App Store, guys, and brand power, and services as a percentage of revenue is increases. So these temporary issues, guys, I still do believe that they are temporary issues for Apple, but temporary doesn't maybe mean 1 or 2 weeks. This could even last over the next 3 to 4 months until Apple puts out its new suite of AI products. If those suite of AI products, guys, are not massively well received by the company, we will potentially have a problem with Apple, which is why I'm going to be very focused on the pricing that we receive for shares. I am not going to be buying Apple up here. I need to see more of a discount because there are current risks to the business, even though it has a tremendous moat, right? So a little bit of a recap here on the numbers, guys, in terms of their fundamentals, right? So fundamentals, we obviously saw that the revenue was relatively flat, but EPS and profitability is going to the upside, although revenue has been roughly flat. So at least they are expanding on those fronts. In terms of the valuation, now though, guys, valuation is very, very hot right now for Apple. So EPS growth of about 10.5% per year gives them a PE ratio at 214 of 32.5. In Apple's history, that's been roughly standard. Usually you kind of want to find them around a mid 20 to high 20s PE for a very good deal. 32.5 is not elevated, but the problem, guys, is they run a very high PEG ratio. We did the same analysis down here at the 170s, and when they were at the 170s, guys, it really wasn't too bad. They were sitting at roughly a 2.4 PEG, 2.5 PEG, which is justified for Apple. The business is very consistent. It's very predictable as well. So Wall Street tends to give it a more higher valuation because it's more of a defensive tech company like Microsoft, right? Same thing that happens with Microsoft. But when we get into PEG ratios over 3, that's where even someone like myself, who's very long-term bullish on Apple, that's where even someone like myself, guys, I have to say, this is just too expensive right now. So currently right now, Apple sitting in the after hours, right, at their current price of $219.60, a little bit too expensive for me. I've said it on the channel before, I would only be interested in buying Apple if we come closer to the $200 area. 200, 190s, again, if the rest of the market continues selling off, that could be a good opportunity for long-term purchases in Apple. But however, right now at 219, guys, especially with a lot of uncertainty in the markets right now and uncertainty about Apple's ability to continuously grow revenue, I'm just not convinced, and I need to see a better discount to be able to take that risk personally myself, right? So that is pretty much everything we had to say about Apple. So moving on in, guys, let's now cover our technical analysis on the indexes. Give me a very quick second. And let's get right into it, right? So moving on into the SPY, guys. So SPY has been an absolute roller coaster, just as the QQQs have been over the last week of trading. We were focusing on the fact that yesterday we did have a new daily uptrend. And even with today's weakness, guys, we did not break the lows. Is it looking a little bit dicey? Yes, but technically speaking, this is still a daily uptrend. We will see, even with Amazon's poor performance from their earnings, we will see tomorrow, especially with the jobs report, guys. If the jobs report comes in good, then we're fine. The markets will probably recover. However, if the jobs report is a lot weaker than expected, guys, I would not be surprised to unfortunately see the SPY resume the hourly downtrend and unfortunately lose these daily higher lows and plunge back into more daily consolidation. And if we lose this level right here, guys, and plunge a little bit lower, same thing that happened right here is going to happen, right? We're going to be under this big area of support for 550 all the way down to about 542, maybe use it as resistance into the next week, and maybe just continuing on plunging as the markets remain a little bit fearful right now, right? So keep an eye on that. If that scenario does play out here tomorrow, guys, into the next week, we will just be into further weekly consolidation on the S&P 500, and at least we have a decent amount of space still above our weekly higher lows. This is still a weekly uptrend, guys, right? The weekly higher lows are right here at about 516. So far, we have not lost them. If we continue pulling back, then we will look at this larger area of support, 531 down to about 515. This is going to be the likely area where the bulls put a stop to it, right? But could we see something like this? Bounce and then maybe resumption of the downtrend and attack it again? Yes, we saw the exact same thing last fall. And I will remind you guys, we are in a bit of period of weak seasonality right now. Usually in the months of August and September, you can see slight declines, right? This rally early on in the month of August so far has not manifested. I think this was pulled forward in the early month of July. August and September, I'm sorry, I closed the chart, the other seasonality chart. So usually August and September are weak months for the markets. So if we continue similar to last fall with all this uncertainty around the economy and the jobs, did Powell wait too long before rate cutting? And also uncertainty surrounding the election, we may end up in a weekly downtrending cycle. So just pay special attention to how this market breaks tomorrow. If we break this to the downside or if we're able to resume the uptrend, right? It's going to be a key focus for price action into tomorrow's session. So definitely going to be a very volatile day to say the least. Myself, I may be a little bit more patient to deploy more capital until we dive into this area on the SPY. Moving on to QQQ. So QQQ down 2.42%, guys. QQQ also setting a bit of a daily uptrend into yesterday, not quite flushing the lows right now. So we're coming into a little bit of a triple bottom area, right? Tomorrow, jobs report is front and center. The QQQs will probably open a little bit red because of Amazon's negative performance, but we will see, can the jobs report save us? If ever we do not get saved, guys, keep a special eye on this hourly downtrend. Very, very hot momentum, right? Hourly, not quite oversold, and because of yesterday's bounce, 4-hour, not quite oversold either, right? So we do still have room to fall if ever that's the case tomorrow's session. If we break these lows, unfortunately, guys, loss of the new daily uptrend, and we will just continue weekly consolidation. So far, we are getting a bit close to the weekly higher lows. 444 is the weekly higher lows. Still a weekly uptrend, but get too close to this area, and you risk potentially a longer form consolidation for the markets, or at worst case scenario, a weekly downtrending scenario, guys. So pay special attention to how the markets react from this price zone right now. 449 down to about 435. And if we break these lows, guys, the QQQs will officially be in a correction. A correction is 10% plus drawdown. This would be the first correction pretty much that we saw since last fall when it dropped all the way to 11.9. So are we currently healthy, guys? Well, I do believe that in terms of the overall positioning of the market, right? Yes, the bulls are in clear control of these monthly uptrends, but in terms of short-term positioning, I wouldn't be surprised if we get continued weakness, guys, with if economic data continues being a little bit weaker, if technology continues to see a rotation out of semiconductors and out of large caps in favor of more defensive names and maybe even bonds, then this decline could continue. However, the moral of the story, is it a good dip buying opportunity for the long term? Absolutely, guys. We need to be buying these dips. I will reiterate it, guys. If it is not painful when you are buying dips, you are not buying the correct size dips, right? I'm not talking about these tiny little dips when we're in overall daily uptrends, right? We get 2-3 days worth of pullback, right? 1.5%, and you buy the dip here, right? Hoping for further upside. These are the dips that we need to be buying when big tech is 10, 15, 20% off the recent highs, when it feels like the market's going to crash, right? That is when we need to be dollar cost averaging, because when we look back at these times in 3-4 months, we will be very happy with the purchases we made. I can pretty much almost guarantee that. Moving on into XLF financials right now. So financials, guys, retracing a large amount today, 1.42%. And a large majority of that, guys, was due to the, the small cap banks, right? So I don't know what happened with small cap banks today, but they were down about 4.48%, which really dragged down financials as a whole. Now, moving on in, guys, still very, very nice daily move, but now the bears have taken back a lot of this move, right? So we're looking for a daily higher low for continuation of this daily uptrend. However, the bears have now taken back a sizable chunk of this move. And if we fall any more tomorrow, guys, this is an 80% retracement. Usually when we get an 80% retracement, guys, it's either met with a tightening range or worst case scenario, a loss of the daily move and into daily downtrend. Now, if we get the worst case scenario of those two, just keep in mind, the bulls have a lot of space, guys. Weekly uptrend, looking for a weekly higher low for potential weekly upside continuation. So if we see a couple weeks of weakness here, guys, with the rest of the markets, we could be pulling back into the 42 to roughly 41.5 pocket that we have right here to maybe set up for a weekly higher low before resumption of the weekly uptrend. Usually financials respond very well to interest rate cuts. So as we move into further consolidation and get closer to that September rate cut, that is maybe when financials could see this curling effect happen, right? As of now, the daily bulls have not lost this, but it is not looking too good with the size of this pullback. So be very, very mindful of that. Moving into healthcare right now. Healthcare outperforming today, the only major green sector that was green. So daily uptrend right now is clear as day, looking to smash the all-time highs, 150, 150. If we get that, daily uptrend is resumed. And then to the downside, if we somehow flip, guys, keep a very close eye on your lows, 149s. If we lose this without making a new all-time high, daily downtrend is underway, and we will start a little bit of weekly consolidation. Good for the bulls. They have a lot of space for it, right? Weekly higher lows can be set. Anything pretty much 147 down to 145. Beautiful pocket of prior market resistance at the all-time highs could now be great support for a retest and maybe run for these markets. So Healthcare still looking relatively bullish in the grand scheme of things, should be one of the beneficiaries of the rotation from big tech and semiconductors if it continues going down into healthcare. And we've taken note of this, guys, over the past 3 weeks. It's been one of the best trades in the market. Moving into semiconductors right now. Semiconductors, guys, what a roller coaster, right? Disaster happening on the Tuesday session, and then total euphoria coming in yesterday, 7.5% to the upside. And then they gave it all back today, guys, almost 7% to the downside. So very big roller coaster. We were watching the size of the bounce. The bounce was good, but when we have a good bounce, guys, the bounce is step number one. Then it's up to the bulls to set up for a higher low and change this bounce into a daily uptrend. So far, that has not been the case. The bears just coming in way too strong today. So unfortunately, we are now retesting this level of support, right? 238 down to about 225. We're really in the mix of the support level right now. Be very careful, guys. If we lose this to the downside, it will not be good, because then we can then use it as resistance and continue a weekly downtrend. So semiconductors are holding on by a thread right now. We will see what happens in tomorrow's price action. But if we lose these lows into tomorrow and lose this support zone, guys, it is not going to be looking very good. Daily downtrend at that point will simply continue. Weekly consolidation will simply continue as well. And then we're going to be into, guys, a little bit heavier monthly consolidation for the markets. Pay special attention. Monthly higher low is right here, 198, right? So still looking for the monthly higher low, maybe trying to tag the 12 EMA. So could we have a little bit more consolidation in semiconductors? Absolutely, guys. It is definitely on the table, but I want to remind you that for a lot of these companies, the fundamentals have not changed. 2025 is going to be an explosive year of growth for semiconductors as a whole, right? And every single company that has reported this far, this quarter, has said the exact same thing. In the second half of 2024, right, the first half of 2024, a little bit of cyclical weakness as other manufacturers get through the inventory of semiconductors that they built up during 2021 and 2022 and 2023 as well. Now, this first half of this year has been relatively weak, but they all guided that the second half would be strong and 2025 should be a blowout year. So this is the perfect moment in time for these things to be in consolidation. Just keep that in mind. The fundamentals of these things have not changed. It's just there was a lot of bullishness in the AI trade this entire year so far, guys. And now we are just having some healthy market consolidation and rotation, in my humble opinion. So I will still be buying dips on my favorite semiconductor companies, guys, but only the best companies in the game. More specifically, TSM, ASML, Broadcom, and perhaps NVIDIA as well. The rest are what I refer to as beta plays. They are running because the rest of the market is running. Think of companies like Micron. Think of companies like SMCI. Think of companies like ARM, right? They are not as powerful as the companies that I previously listed. So I am only going to go buying dips on the most solid companies in the entire industry for now, okay? So that's how I'm playing semiconductors. Moving on into IWM Russell. IWM Russell down 3.25%, having its worst day, guys, pretty much in the last couple of months, right? You'd be hard pressed to find a 3% down day on the Russell, but we were wary of this because of the overall weakness in the markets, guys, and because of the Russell coming into a very large area of resistance up here, 2021, huge area of resistance. Without overall market bullishness, it's going to be impossible for the Russell to blast through this area of resistance, guys. It's just not going to happen. And today was a testament to that. Losing the daily uptrend, right? So fracturing the daily higher lows right there. So now the bears have pulled down significantly. And because we were so high, guys, yes, slight oversold conditions on the 1 hour, 4 hour, not even close. So we will see, can the bears set up for a maybe lower high, lower low conversion on the 4 hour and just continue this daily slide even further? Then maybe on the daily bounce, we may just get lower high into lower low conversion as well, guys, as the rest of the markets unwind. So this might just be the end of the Russell's temporary rally for now. Now, in terms of the weekly, guys, looking at the weekly uptrend is clearly in motion, looking for a potential weekly higher low. And I'm going to be paying special attention to how we react from 211 to 206. Huge prior resistance for the markets. It took several months to get through this location. If the bears just blast through this as if it's not even there, guys, I'm not going to be buying this dip, right? We have to just see the price action for what it is. If we react nicely to this location right here and the rest of the markets have a little bit of turnaround, yes, I can try to make a little bit of a dip buying opportunity on the Russell right there for a little bit of breakout, retest, and maybe run. But as of now, guys, the momentum to the downside is very, very strong. I need to see how price action reacts in the next coming week of trading to determine whether or not I'm happy to buy these dips over here, or whether or not I want to wait for maybe a little bit of the seasonal weakness right now, a little bit of the recession narrative to kind of dwindle away, right? We got to be very, very careful when playing small caps, guys, because you know how quickly these things can reverse hard. Moving on to the Dow Jones right now. So the Dow Jones also having one of its biggest declines in recent memory, right? You'd have to go back all the way to the month of May to find such a steep decline on the Dow Jones of roughly 1.21%. Actually, we had one here right in the month of July from the all-time highs. This one, however, a little bit bigger top to bottom. So all that being said, guys, daily downtrend was in motion, big engulfing move, looking for a potential daily higher low to maybe reset into a daily uptrend. However, be careful, guys. The size of this retracement is quite large, retracing almost 80% of the move. So the best case scenario for the bulls right now is maintaining a tightening range above our prior all-time high resistance, which is now support. Would love to see them maintain a tightening range above here and consolidate. However, if we have a big move down like this, guys, if it continues and erases all of this bull move, a very high likelihood of setting up a daily lower high into lower low daily downtrend conversion and just plunging us into a little bit of weekly consolidation, right? Nice 5, 6, 7 weeks of rally. Now may just be time to cool it off, set up for a weekly higher low, and then maybe run thereafter. So can we see a couple of weeks of weakness for the Dow Jones? Absolutely. We will keep a special eye on how markets react to our jobs report that comes in tomorrow, guys. It is absolutely crucial piece of data because either which way, it'll either fuel the recession narrative or it'll take away some of the pain that we had today. So very emotional market nowadays. We have to pay special attention on the price action, guys, because we're playing into larger weekly levels of consolidation right now across everything. So that's pretty much everything for your indexes. Now, moving into Apple. So moving on into Apple, guys, Apple, we just covered them for their earnings, but the technical analysis should remain, right? So right now, they're pretty much sitting at exactly the same point in time. Daily downtrend, nice bounce by the bulls, but can they keep it up, right? Pay special attention to the loss of these levels, 215. If the markets roll over tomorrow into next week as well, guys, it'll just be a continuation of the daily downtrend into a continuation of weekly consolidation. And then we need to pay special attention to 206.87. Come too close into this location right here, guys. You open the doors for a potential weekly downtrend rollover on Apple, which would lead us into a bit of monthly consolidation, especially with the way the month of July closed and how August is opening right now. May just be time for Apple to consolidate into maybe the month of September, when they're releasing their new iPhone and AI-capable MacBooks as well, that this would be the absolute perfect time for Apple to consolidate in this technical pattern for a breakout of the all-time highs, retest, and then maybe run into the later part of the year, think Q4, when they'll have a lot of sales from their iPhones and the new MacBooks with AI capabilities, right? So this is really the setup that I'm seeing play out for Apple right now if the rest of the markets continue declining over the next 1 month. Moving into AMD right now. So AMD, guys, so unfortunate what happened to AMD, right? They were on such a nice rally right here in anticipation of good earnings. And then we've absolutely gotten destroyed, right? Down 30% since the 11th of July, guys. Not even 3 weeks, down 30%. And they had great earnings. And unfortunately, now we have erased all of earnings, down 15% from the high of the earnings move. Very, very nasty move down by AMD, obviously not fueled by fundamentals whatsoever, really fueled by just traders and institutions just exiting the AI trade left, right, and center and just dumping semiconductors, right? So that is pretty much the moral of the story for AMD right now. Unfortunately, guys, back now into daily consolidation, right? So the daily bears completely engulfing the earnings move. And now we got to be careful, guys, because if we close under the 130 area, this is the last area of support that we have before diving into the 117 to 109 down here. So if we lose this, unfortunately, if the bulls do get a bounce, we'll just be looking for a lower high. This whole green box becomes resistance and may just be looking for lower lows coming into the 120, 110 levels. At that point, AMD will probably be heavily daily oversold. I apologize. I need to move myself over. They will be heavily daily oversold. So we'll keep a close eye on price action for AMD. Just remember, guys, we did their earnings literally yesterday or the day before, right? Their earnings were fantastic, and their PEG ratio is extremely cheap. Valuation was cheap at 145. If we come down here, guys, anything below 125 down to 110, very nice buying opportunity for the long term on AMD, in my humble opinion. Even if we have extreme fear, guys, I will be buying the extreme fear dips on AMD more specifically, right? So keep a close eye on the price action on AMD. They're really at the point of no return right now. They can either save this with a decent bounce with the rest of the markets coming into tomorrow, try to save the daily uptrend. If we lose the support area, guys, it is not going to be very pretty. At that point, I do really think that we're going towards the lower 120 area. So very unfortunate for AMD. Couple that with the fact that we've lost every single major time frame as well, right? Weekly uptrend completely lost. And unfortunately, even now, guys, the monthly uptrend has been lost by AMD over the last 2 months of trading, which is why I do believe if this monthly consolidation continues, guys, we may just start to see some of these lower levels down here where we have prior big monthly support, right? Very unfortunate for AMD, but I will continue buying these dips on this company as I do believe it is very well positioned for 2025. Moving on into Amazon right now. So Amazon, of course, down 7% in the after hours. They're literally right now at 170, which is the 200-day moving average. Now, Amazon is in a daily downtrend as of right now, so daily uptrend was confirmed as of yesterday, and now they lost it, right? So at any given time, guys, Amazon will probably have to set a lower high, and then it'll be up to the bulls to confirm whether or not they can protect that higher low, and reset into a daily uptrend, or whether or not we just roll this one over too, right? One thing's for sure, as we just covered on the earnings, this is a very solid area of support. Huge weekly support for the bulls, right? And this is just the top end of that support range, but it really goes all the way down into the kind of low, the 160 range, even the high 155s. And if we get a retest any point of this time, 170, guys, all the way down to about 155, screaming buy opportunity for Amazon, in my humble opinion. Yes, the technicals do not look too good right now. I will give you that. Obviously, right now, it is unfortunately going to be a weekly downtrend motion with these earnings, which leads us into monthly consolidation for Amazon. But look, we still do control the monthly uptrends right now. The monthly higher lows are right here. If we lose those, guys, it'll be a loss of the monthly uptrend, but Amazon can get it back. It'll just take a lot of time. So I do believe that this is going to be a good buying opportunity for Amazon, guys, but we may just have to be very patient with this one because of recent market conditions. I am a firm buyer of Amazon down here. Tomorrow, I will be adding a couple shares to the long term. And as we fall lower and lower, if we do, continues to be a long-term buying opportunity, in my opinion. As I was saying in the earnings recap, 17 all the way down to 20% on Amazon in the context of an overall bull market should be a very decent buy. And 2025 should be a killer year for them as well. So long-term investment, absolutely from me. Moving into Google right now. So Google, give me a very quick second again. Let's get into Google as well, right? So Google down about only 0.4% today. Google is going to have to work really, really hard, guys, to protect this new daily uptrend attempt, right? So daily downtrend is clear as day on Google right now. Lower highs were set, and now we need to protect these lower lows right there. The size of the bounce of this recent move was okay, a 50% bounce, right? But that does not guarantee that the bulls have a chance at resetting the daily uptrend. If anything, guys, with continued momentum to the downside, Google can just lose these lower lows and continue the daily downtrend. That is the expectation right now. We're getting rejected from this area of resistance, and we may just be heading a little bit lower on Google over the next couple of weeks if the market continues selling off. Where does that put us on the weekly, guys? Well, pay special attention. Weekly uptrend is now lost by Google as well. And if we continue this slide, it gets a little bit dangerous, guys, because we could be setting up for the weekly lower high into weekly downtrend, which would lead us into further monthly consolidation. Good thing for Google, they have a lot of space on the monthly. Anything above 134, looking for a monthly higher low for continuation of the monthly uptrend. Where could we maybe stop, guys? Max pain for Google would probably be a 15 to 20% drawdown, the bottom of which maybe 155 to 160, tagging this monthly 12 EMA, which Google has respected this entire time we've been in this bull upswing, right? So pay special attention on how Google reacts to the market data tomorrow, and pay special attention whether or not we continue this daily decline. If we continue, Google, guys, will not be at bay from declines in the rest of the market. However, I love this one, guys. Absolutely love it. If we come into the low 160s, even high 150s, I will be a very big buyer of Google. Just remember, guys, anything 15, 20% Google sell-offs, usually a very great buying opportunity. You see the one right there, see the one right there, 12%, right? And we go back to prior bull markets, always the same. If you can find Google 15, 20% off their all-time highs, very good buying opportunity in my humble opinion. And nothing has changed with any of these big tech fundamentals. I reiterate this, guys. Their earnings were good. It's just the market environment we're in right now, which is translating to declines in share prices. But the fundamentals of the business, guys, are very strong, which is why I maintain we have to keep buying these dips, even though it's painful. Moving into Meta right now. So Meta, at one point in time today, Meta was up a significant amount, over 11%, before retracing more than half of it, only ending up about up 5%. So very good, one of the only green names in tech today, but daily uptrend is clear as day right now for Meta. Meta now has a lot of space, anything pretty much above 458, just gonna be looking for a daily higher low and moving on into a potential daily uptrend continuation. But guys, Meta cannot do it alone. If the rest of the market continues selling off, do not expect Meta to continue to have outperformance, right? We may just start revisiting. And if the bulls give back too much of this move, guys, talking about over 50%, right? Now, top to bottom, you see they've given back about 50%. If we give back over 50%, guys, may just be case in point, Meta can give up this entire move, set up a new daily downtrend, and once again, dive into this level of support, which is 483 down to 465. The weekly would also support that as well, right? Weekly move with earnings was nice, but if we can't get it done, guys, we may just head into a bit more consolidation on the weekly. Pay special attention to how we react once again from the support range. If Meta unfortunately loses this over the next few weeks, guys, I've maintained this on the channel. If Meta falls, keep an eye, monthly uptrend, looking for the monthly higher lows as well. If we fall, if for ever which reason we crack 450 down to about 420, tremendous buying opportunity for Meta. So as a whole, I remain extremely bullish on this company. We covered their earnings yesterday. The valuation, even at 500, is extremely cheap for Meta right now. So anything under 500, 480, 460, 420 becomes even better value for this such a solid company, right? So the technicals on Meta are looking good, but as I said, guys, it cannot do it alone, unfortunately. Now, moving on into Microsoft. So Microsoft down a tiny 0.3%, but still down, guys, right? Daily downtrend on Microsoft simply continues at this point. So if we continue red into tomorrow with negative data, guys, we will be looking to the bottom end of this support range over the next few days to act as a last line of defense. It was a huge area of support stemming all the way back from the entire year. So this one is going to be a big one for Microsoft. The 200-day moving average is sitting right there as well at about $405. So I'll be on the watch for this area. Keep an eye on the weekly as well. Huge 4 weeks of weekly consolidation for Microsoft. The last time that happened was last fall, right? Usually if we come down all the way there, be a sell-off about 15% on Microsoft, which is pretty much the same last fall. If we do come down there, guys, the fundamentals of Microsoft are amazing right now. I will be buying the dip on this one, but short-term momentum right now does favor the bears. I will remind you for all these charts, what do we need to see to reverse these declines is we need to see an hourly uptrend shift. We had it yesterday after the earnings, and you can see today, we lost it and now potentially into a new hourly downtrend. So that was the top of your daily move. The bounce was good, but if the data tomorrow is bad, we may just roll over, fracture the lows, and be heading into another leg of daily downtrend, which could culminate into maximum pain in this location down there. I will be buying Microsoft down there. Now, moving on to Netflix. So Netflix down only 0.56%. Netflix has been doing a better job than other big tech names and really holding up as best as it can, even though it has been declining ever since that, early July portion, right? So daily downtrend on Netflix is still underway. The bulls tried to have a bounce today, and we unfortunately gave it all back. So if your hourly downtrend continues into tomorrow, unfortunately, guys, this daily downtrend will continue by breaking these lows. And then we come to the bottom end of the support range, 606. Lose 606, guys, and we can drop the levels very quickly. The next big level comes in at about 571 down to about 550. This location right there is where I'm more heavily inclined to be buying Netflix, closer to its 200-day moving average, guys, and closer to what I deem to be very good monthly support as well, right? So the monthly higher lows are down there too. Could just be looking for a monthly higher low for a continuation of the monthly uptrend. So that's pretty much what I'm going to be looking for on Netflix, guys. If we ever do lose this location over the next few days, I will be looking for that eventual last flush on Netflix down there. Maximum pain, in my opinion, 580 down to about 550. That should do it for max pain. That would be a decline of anywhere between 18 and 22% on the company. Moving into NVIDIA right now. So NVIDIA, what a roller coaster of a ride on NVIDIA, right? NVIDIA up pretty much 13% yesterday, and today giving back almost half of that. So NVIDIA had a gorgeous bounce underway. They were trying to reverse this into a daily uptrend. They still have a chance, guys, right? They still can set up the daily higher low into a daily higher high, but that is going to be predicated, guys, on the release of the data report tomorrow. If the data report is bad, it does not matter what NVIDIA's technical setup is looking like. They will flush this stock, mark my words, right? So even though we still do have a little amount of space, and can try and set up the hourly uptrend again, if the data is bad, guys, we are going to be rolling over on NVIDIA. At that point, it's up to the bulls to protect this level right here, 103.61. Flush 103.61, your daily downtrend, unfortunately, simply just continues at that point, and weekly downtrend also just continues. We are coming into a very big area of support on NVIDIA, 103 down to about 94. There is that infamous earnings gap fill to be had at 95, and if overall market weakness continues, I would not be surprised if NVIDIA goes all the way down there to fill that gap. This is where I want to start buying NVIDIA, guys. Personally, it's very close to the 200-day moving average, which is about at 87 as well. So I maintain, guys, right? If market weakness continues, max pain for NVIDIA, in my opinion, is about that mark. 94 all the way down to about $83. This location right there, probably max pain, right? That would be a huge weekly downtrend sell-off potentially, and a huge monthly consolidation leg down for NVIDIA on the monthly as well, right? Gorgeous monthly uptrend, looking for the monthly higher low for the eventual monthly trend recapture. Nothing is wrong with the business. It is just in an industry that is out of favor with traders and investors right now. People really just taking their gains and really preparing themselves for this potential recession narrative and rotation out of tech and out of semiconductors into more value and defensive oriented names. Be very careful with NVIDIA. Great company, but it has ran a lot, and in that case can be one of the biggest candidates for an extreme sell-off. Moving into Tesla right now. So Tesla giving back most of its gains from the whole week, down almost 7% on the day. Daily downtrend on Tesla is clear as day right now. Keep a special eye on these lows. We've almost broke them. If you do break them, guys, daily downtrend simply continues. And unfortunately, weekly consolidation simply continues as well. Tesla right now in a weekly uptrend, the bottom of which, guys, Tesla really has to start reacting, 210 down to about 190. This is the last line of defense for the bulls, right? This huge area of support has been support for the stock a few times over the last 3 to 4 years. And this is really where it counts. All of the moving averages are right here. We have not been above all of the moving averages, guys, since November of 2023. It's been a significant amount of time, right? So I need to see the Tesla bulls protect this and maybe get into a bit of longer form tightening range pattern, right? If ever we come too much far down in here, well, the bulls have been giving back way too much of this move. Keep in mind, we've already given back more than 50%. If we come even lower, 618 or 80% retracement, guys, it's going to be very tough for the bulls to retain any momentum whatsoever, and we could just see the formation of a new weekly downtrend. Tesla, I want to start playing it myself, specifically under $200. Think 190, 180, where this larger form support was earlier on in the year. So as of now, Tesla just being dragged down with the rest of the market. Very unfortunate, but is not yet a dip buying opportunity for me. That really comes into the lower 180s if ever we get there. Now, moving on into Palantir. So Palantir down about 3% on the day, just can't keep it up, right? Nothing wrong with Palantir's business. Palantir reports earnings on the Monday session, just a byproduct of the overall AI trade really collapsing in front of our eyes right now, right? So Palantir looking to move maybe into a daily downtrend. If we break last Thursday's lows right here at 25.55, daily downtrend unfortunately is underway for Palantir, and we're coming up into this big area of support, guys, but it is with very strong momentum to the downside. So if ever we lose this with the daily downtrend, guys, keep a special eye into further weekly consolidation, the bottom of which could possibly be the 24 down to about 22 location right here if things start getting really bad. Obviously, everything's going to be predicated on their earnings. Not too many sessions before their earnings. So Palantir does have a chance at possibly setting up the weekly higher lows now. If they smash it out of the park with earnings, we could see a nice little rally into this big area of resistance, $28, which is going to give them a buffer if ever the rest of the market continues to sell off, right? So earnings is on deck. Very tough to predict the price action, guys. If earnings are negative, you guys know we're probably heading back 24, 23. But if earnings are well received, we could really start attacking 28 to 29 once again. I will be on the sidelines on this one until earnings. So that is pretty much everything we had to recap in today's markets, guys. I apologize if I had more of a bearish tone in today's markets, guys, but we really have to be attentive, right? So I'm not too sure what's happening in futures right now, but we are down in futures 1.15% on the NASDAQ and another 0.7% on the S&P. So tomorrow's data is going to be absolutely crucial, guys. Now it is time to buckle up, right? Put our emotions to the side, build a shopping list of companies we want to go shopping for, and start buying these dips. Little nibbles, guys. Do not full send the portfolio into dips right now. In my humble opinion, guys, if you want to ask me my feeling about these markets, with so much uncertainty now around the economy and the jobs data, they have been strong, right? But what overpowers this is the narrative. The media is going to start pushing the recession narrative, the fact that we waited too late to cut interest rates, and it's going to pour into the stock market. Couple that with election uncertainty and seasonal weakness in the months of August and September for the markets, we could have a repeat of exactly what happened, guys, last fall, right? Yes, we're going to have some gains all throughout, but for the most part, more declines than upside in the next at least maybe 4, 5, 6 weeks of trading. So we need to be prepared for that, guys. If you're trading and you don't want to withstand the volatility, by all means, it is perfectly fine to sit on the sidelines and build up some cash and wait for all of this uncertainty to really be behind us. Wait for the rate cuts and wait for the election cycle to be over, right? That is a very decent way of playing things. For everybody who's a long-term investor, now is the time to start to buy your favorite companies. The whole time that we are dipping, guys, the only time you should be buying the only time you should be adding heavy into your companies is when we're facing a situation right now where we're coming into oversold conditions and maximum pain and a little bit of fear in the markets, right? If you feel pain and if you feel anxiety right now, this is when we need to be buying these dips. I'm telling you guys, market history is never wrong. It's usually always a very good opportunity to be buying these dips when we are in a situation of uncertainty and fear in the markets, right? So just keep that in mind and let's build a very nice shopping list to go shopping over the next 4, 5, 6 weeks. But please protect your portfolios as best as you can if you are trading, right? Keep that in mind. The overall trend right now is down. So be very careful with any call options, right? And if you're shorting, right, just play the trends. Play the trends. That's all I have to say. So take care, guys. That's pretty much everything I had for today's video. If you enjoyed today's video, consider dropping a like for the growth of the channel. Would really appreciate it. Consider subscribing to the channel if you're new as well. Would love to see you back here. We do these every Monday to Friday after the close. And also, guys, if you have any questions at all as to how to play these markets, I've explained it a ton over the past 2 weeks, but if you have any specific questions or specific stocks you're considering, anything you want, leave it down below in the comments and I'll be happy to answer you within the first 24 hours. Take care, guys. Be very careful in tomorrow's session and over the forthcoming weeks. I love you all, but be very careful. Start building some cash, build a shopping list, and let's absolutely crush this dip together, the same as we did on the channel last fall and in the month of April too, okay? So take care, guys. See you tomorrow and peace.